Corporate ethics significantly impact investment returns by influencing investor trust, market reputation, operational efficiency, and long-term sustainability. Here's how corporate ethics can affect investment returns. Investor trust and reputation. Ethical behavior enhances investor trust and confidence in a company's management and operations. Companies known for ethical practices are perceived as more reliable and transparent, attracting long-term investors and potentially lowering their cost of capital. Risk management and compliance. Ethical companies tend to have robust risk management frameworks and compliance procedures in place. By adhering to ethical standards and regulatory requirements, companies mitigate legal and reputational risks, reducing the likelihood of financial penalties or market disruptions. Operational performance. Ethical practices contribute to operational efficiency and effectiveness. Companies that prioritize ethical behavior often have higher employee morale, lower turnover rates, and improved productivity. This can lead to lower operational costs, higher profitability, and enhanced investment returns. Brand loyalty and customer relations. Ethical companies build stronger brand loyalty and customer relationships. Consumers increasingly prefer to support companies aligned with their values, leading to increased sales, market share, and sustained revenue growth. Positive brand perception can drive higher stock prices and shareholder returns. Long-term sustainability. Ethical practices promote long-term sustainability and resilience in volatile market conditions. Companies focused on environmental, social, and governance (ESG) factors are better positioned to navigate regulatory changes, societal expectations, and industry disruptions. Access to capital and cost of financing. Ethical companies often have better access to capital and may enjoy lower borrowing costs. Responsible investment practices attract socially responsible investors, SRI, and institutional funds that prioritize ESG criteria, expanding funding options and reducing financing expenses. Legal and regulatory compliance. Ethical behavior ensures compliance with legal and regulatory requirements, avoiding costly fines, litigation, and reputational damage. Companies with strong ethical cultures prioritize transparency, accountability, and adherence to corporate governance standards, enhancing investor confidence. Risk of scandals and reputational damage. Ethical lapses or corporate scandals can lead to significant reputational damage and financial repercussions. Negative publicity, consumer boycotts, and investor withdrawals can erode shareholder value, decrease market capitalization, and harm long-term investment returns. Investment performance and stakeholder value. Ethical companies often outperform their peers in terms of financial performance and stakeholder value creation. Sustainable business practices, ethical leadership, and stakeholder engagement contribute to higher profitability, shareholder dividends, and overall investment returns. Regulatory and market perception. Ethical behavior enhances regulatory compliance and fosters positive perceptions among regulators, analysts, and institutional investors. Companies committed to ethical governance practices are perceived as lower-risk investments, potentially leading to higher stock valuations and investment returns. In conclusion, corporate ethics play a critical role in shaping investor perceptions, operational efficiency, and financial performance. Companies that prioritize ethical standards and responsible business practices are better positioned to generate sustainable value, attract capital, and deliver favorable investment returns over the long term.